What I really want to do through the course of this is just to give you an overview of sort of what's happening in the indexing world, what's happening in the ETF world. I know a lot of the interest here is around sort of stock picking, but here it's sort of more high level. At the funds level, talking to you about passive funds, talking to you more about ETFs, and comparing sort of the growth in the ETF business, which is fairly new, especially in Asia, and contrasting it to sort of what's happening in the developed world, namely in the US. So without further ado, this is a little bit about Vanguard. We have been around since 1975. We're a pioneer in the concept of index investing. We're a leader in low-cost investing. So I think if there's one thing you should take away from the talk today, it's just that costs matter in investment. All right? You can't just look at an active manager performance and say, all right, you've outperformed the benchmark by 1% or 2% without accounting for costs, right? Because costs eat into investment performance, right? So just remember that as we go through the session. Talk to you a little bit about the unique Vanguard structure because that will sort of help set the context for why we do what we do and how we do it, okay? All right, so this is a little bit about Vanguard. Has anyone heard about Vanguard before? I see less than 5 hands, and Richard doesn't count. So that's all right. We're basically a big US firm. We've been in Singapore for about 10 years, but primarily we've been dealing with institutional clients. We don't really sell to the retail market here, just because of the scale, size, and scope. We're just a small office of 6 people here in Singapore, but eventually we're growing, and hopefully there'll be more interest in ETFs and index funds over time. So we were founded in 1975. Right now we manage $2.15 trillion worldwide. Okay, so that's not a typo, that is trillion. Chairman is currently Bill McNabb, and Bill's, I guess, his legacy is going to be how he built the international business. Because for the longest time our growth was so rapid and the US market is just so big that we really didn't pay as much attention to the international market, but he's really put a big emphasis on growing that international market, and I think that's part of the reason I'm here to talk to you guys. Okay, so really quickly, this is our corporate structure, and it's a little unique. I'm not going to spend a whole lot of time, except I'll tell you that most mutual fund companies that you talk to every day follow like the bottom structure, right? They have clients who buy their funds, and then they have investors, right, who buy their stock. Now, when you invest in a company like that, there's an inherent conflict of interest for the mutual fund manager. And what is that? Basically, if I charge you higher fees, right, the people who own the stock benefit because they'll get more of a dividend payout at the end of the month, but the investors lose out. Or if you reverse it, if I lower the cost of my fund, right, the clients benefit, but the private owners lose out. Vanguard is structured differently, all right? In this, the clients actually own Vanguard. So what does that mean? That means if you own a part of the fund, then you own a part of Vanguard. So we're not a publicly traded company, but at the same time, we're not owned by just 2 or 3 owners, okay? It's a mutual structure, which means we will estimate our expenses, right, for the year. At the end of the year, we'll see how much revenues we have. Anything excess we have goes back into the funds, and the way you see it, in the form of lower cost. Okay? So if you compare Vanguard to anyone else in the industry, we are the lowest cost provider for whatever funds we provide. That's a function of 2 things. One is, indexing is a scale business. As you put more and more money, the costs come down, and then because we return a lot of that back to the investor, those costs come down even further. Okay? I know you'll have lots of questions, but it's basically a for-profit company, but those profits go back to the fund investor. All right, let's talk about indexing over the years. In 1969, right, is the first time an institution was the institutional use of indexing. Now, what is indexing? Today, if you go to the Straits Times and you look at the index, you can't just buy the index, right? You'll have to buy a fund that invests in that index and buys the securities exactly in proportion to how it is in the STI, right? So that's what an index fund really means. Now, you can either buy it in the form of a mutual fund, which means you go, you buy, there's an NAV once a month, once a day, or you can go in and buy an ETF where you can see the price trading every minute and then buy and sell. So those are sort of the two ways you can buy an indexed vehicle. All right. In 1976, Vanguard launched its first index fund for individual investors. In 86, we launched our first bond index fund. 1990, first international index in the US. And today, we'll talk a little bit more about sort of the trends in ETFs and indexing. Okay. So Vanguard is an index leader. So currently, we manage more than US 1.1 trillion in index assets. Okay? If you remember the first slide, I showed you 2 trillion. Half of that is in index assets. What's the other half? We do active as well. So we don't say that active is bad. We don't say index is great and you should only do index. And that's because we do a little bit of that ourselves. But for a long-term investor, right, it's good to put the core investment of your portfolio, right, into a well-diversified long-term investment. And then around sort of the satellite, you can invest by stocks, by active funds, whatever you like. All right? Because there's a difference between being an investor and being a trader. All right? So it's important to sort of take those two assets and separate them. Now, basically, how does an index fund manager know he's doing well, right? For an active manager, he needs to be able to outperform the index, right, net of costs. But for Vanguard or for an index fund, the way you really judge is to make sure that the fund is tracking the index as closely as possible. Now, it's not exactly possible to replicate the full returns of the benchmark exactly, right? Because there are costs involved, and costs lead to tracking error. And tracking error is basically the standard deviation of your excess returns. Okay? But a good passive manager will match the return as closely as possible and at the cheapest cost possible. Okay? This is how sort of the assets have grown over time. So you see the red bar, that's basically the domestic index. Blue is bonds, and international is the one in yellow. So you can see over time, we've sort of moved from a very domestic, and in domestic, this means US, right? Balance between more sort of equity and fixed income and sort of domestic products over into sort of more international. So you can see there's a lot more interest in international ETFs now. All right, so what is this talking about? All right, so this is basically talking about how costs and taxes eat into your performance. All right, so basically if you look at the returns of the market, it's basically following a bell curve, right? Some on the left-hand side have done really well. They've outperformed the benchmark. The people on the right have underperformed the benchmark, right? So as you start to take costs into account, right? So let's just take the expense of the fund. What happens is you just take that out of the performance. Your curve shifts, right, to the right. And then if you take taxes into account, it shifts further right. So if you take the first half, right, if you take the first green curve here, you'll see these are the guys who've outperformed the benchmark. But after you take the costs and the taxes out, it's only this portion of the market, right, that's really outperformed net of costs and fees. So you can see it's very, very hard for active managers to outperform, okay? 2/3 of active managers, on average, underperform the benchmark, right? And of the 1/3 that are outperforming, it's very hard for them to consistently do well. That just basically means you can pick stocks right every single time relative to the benchmark, okay? So costs matter. All right, so what is this graph telling us? It's basically we've taken the S&P 500 index in the US, and we've taken the excess return of active managers minus the benchmark on this side, and here we're taking the expense ratio of the fund into account. As you can imagine and anticipate, outperformance becomes less and less and less as the fees go up higher and higher and higher. Okay? So as you can see, most of these active managers have underperformed the benchmark net of costs, and there's only a few of them that are up in that positive category. Okay? So remember, this is relative performance to the benchmark. Okay, so here's where we start to talk about a little bit more about the trends. All right? So the yellow in this particular chart indicates index assets. The blue in this chart is active fund managers. Okay? And as you can see over time, from 2002 through till 2012, there's been a rapid growth in both index as well as active. As you can imagine, active's grown very fast because people are familiar with that, but at the same time, passive has grown very large over time. Now, don't just look at sort of the relative blue and yellow, but just look at the size of the assets, right? You look at 3 trillion in total assets, growing to 5 trillion, and currently there's about 9 trillion in assets under management. So if you look at the growth of just the passive part, the index part, it's growing off of a small base, but it's growing very, very fast. And in 2015, we anticipate the total market to be about 15 trillion, and a significant portion of that is passive. A large part is still active, but passive is starting to eat up into the active space because over time or through sort of great financial crises or turmoil, active managers have not done as great a job as they promised they could. All right. Now we basically take the index portion of the chart here, right? And then we break it down between index mutual funds and index ETFs. So you can see back in 2002, most of the money was in index mutual funds, right? But steadily over time, right, the ETFs are growing faster and faster and faster. Okay? People are just more familiar with it. They know how to trade it. They know how the liquidity works. And I think this is just not just a US trend, but I think it's a global trend. How many people here use ETFs currently? Richard doesn't count. No one else. Wow. All right. I guess we'll have to do another session with you guys on what ETFs are. Okay. So what is an ETF? Right? It seeks to track an index, like we said, but it trades like a stock. Okay? So the unique thing about ETFs is it's a well-diversified basket of securities, but you can see how much it's trading on a day-to-day basis, right? And because of that trading element, it acts like a stock, but it really tracks an index. So you're not married to one particular name or one particular stock. It's well diversified, so that one stock goes down, at least you have a well-diversified portfolio. Okay, so here are the basic benefits of ETFs. You have low cost, right? Remember I told you, active fund managers charge a lot because they tell you, I'm going to outperform, and then they do fundamental research on each company, right? Or they follow sort of technical trends. So it's an expensive business, right? On the other hand, ETF, you're just basically taking the index and replicating it. So it's a low-cost vehicle. You get diversification. Because you trade like a stock, you have trading flexibility. Okay? There's liquidity associated with it. So if you want to get out of that, you can get out of that right away. You don't have to wait till the end of the day like a mutual fund and wait for the price, which you don't even know. There's transparency, so you know exactly what names are in the index are covered here. So it's not like an active manager that's buying outside the index, right? Or holding a lot in one particular index. You know exactly what you're buying when you buy an ETF. Finally, sometimes there's potential for tax efficiency. And again, that depends on jurisdiction. It depends on where the ETF is domiciled, and a lot of factors to be considered. But it does sort of work from a tax efficiency standpoint. Okay, so I think this is just the second last chart. So this is basically showing you the adoption of ETFs, how they typically work in every market. Okay, so this has happened in the US, it's happened in UK, it's happened in the rest of Europe, and it's happening in Asia as well. What starts to happen is when index or ETFs are first sort of introduced, who are the first people that sort of embrace it? It's institutional clients. Okay? Institutional clients mean big sort of central banks, you know, the GIC, the Temaseks of the world. They first adopt it, right? They get comfortable with it, they use more and more of it, and then finally it makes its way to the financial advisor community, right? They see, all right, what are these big players doing? Maybe there's certain things that they're investing in that we don't know, it's new, let's adopt it. But let's see first how they've done. So the advisors will adopt it. Once they get comfortable with it, typically retail clients, and direct typically means retail clients, then they will adopt it. So it's not surprising to me a lot of you are not aware of ETFs or don't invest in them because it's very new. But eventually as the market matures, right, you see this trend following. So if you look at sort of where things are right now, in the US and Canadian markets, all three channels currently use ETFs. Okay? Because it's been around for a while, 1975, people have been talking about it, people have been educating, so there's a familiarity around it. But then if you sort of look at this category, right, as global ex-US markets today, they're still sort of predominantly used by institutional and advisors only. Okay? Some little bit of retail clients, but not a whole lot. And if you sort of look at, you know, Europe and Asia, primarily it's institutional clients that have been using these instruments for a long time. So it'll take time, but the good news about us is because of our structure that I told you about, we're client-owned, our outlook is very long-term. So we don't look to see whether we made profits in 1 year or 2 years. We look to see, all right, how good or how much can we do over a long period of time in these markets. And the very last chart, sorry, I already spoken to that, so I can skip that. All right, that was the last slide. So I've made up some time, so I'll give you, I guess, 10 minutes of break. If you have any questions, I know I went through it really quickly, but the idea was to give you sort of a broad overview of sort of what's happening in other markets around the world. And, you know, you'll be surprised, every market eventually follows that path. It's a matter of time, right? How long, some markets move quicker, some markets move slowly, but eventually we do anticipate sort of a big growth in the adoption of just passive vehicles, including ETFs. Okay? Thanks for your time, and it's great that you guys are here and getting yourselves educated. So
thank you, Rahul.